From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the last day of October 2025. Yes, it's Halloween, and some communities have trick-or-treat tonight. And for the adults, there's the official Halloween bar crawl, Friday and Saturday at Brothers at 4 p.m. Sounds like a pretty full weekend. But wait, there's more. The Carolina Panthers come to Lambeau Sunday afternoon, and your Milwaukee Bucks are in town for the Sacramento Kings before they hit the road for the week. Union City, Indiana police have captured 2 local hamburglars in a daring and deeply misguided freezer break-in. They stole a significant amount of frozen hamburger patties. Both of those hamburglars were caught. The police grilled them for information.
Oh.
A 74-year-old man from India faked his own death and staged a full-blown funeral just to see how many people would show up. He was even in the coffin during visitation. His express purpose was to know how much affection people had for him. His theme for his real funeral, which may be sooner than he thinks, will be, "Fool me once, shame on you. Fool me twice, shame on me."
Oh.
And this last one is a little crazy. Public bathrooms in China make you watch a commercial video before you can get toilet paper. And toilet paper comes from an automatic dispenser. Talk about a captive audience. On the podcast today, we have Art Rothschild, Steve Giles, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. Your hamburglar jokes made me grimace. The NASDAQ up 2.2% this week. A good week overall, closing at the bell at 23,725. The S&P 500 up 0.7%, closing at 6840. That's up 49 points on the week. And the Dow Jones Industrial Average added 356 points, closed at the bell after scraping back on Friday. 47,563 for the Dow for the year. NASDAQ up 22.9%, the S&P up 16.3%, and the Dow Jones up 11.8%. That's a quick look at the week. Art, plenty to point to this week in terms of high-profile news stories. We had you on the podcast a couple of weeks back when we were still working through kind of the I think what were some of the darkest days of the trade negotiations with China, on the heels of now what appear to be at least some agreements in principle, how quickly things change. And go ahead and pat yourself on the back for this one, because I think you called it.
Yeah, this has been a bizarre year. The tariff thing, this is the president's thing, and I think the markets are getting used to it. He does something that causes the markets to go down, like coming up with outrageous tariffs like he did back in April. And like he did, as you mentioned, a few weeks ago when he threatened 100% tariffs or whatever on China. And but we all knew this was a setup. The market went down. And those who sold obviously didn't know it was a setup. But here we are with the week in which he's traveling in Asia, making all these deals, supposedly, with all these Asian countries. And it's just, how much higher are tariffs going to be than they were when we started the year. But I think the good news is at least a couple-fold. One is the tariffs have not negatively impacted inflation, causing it to go up as much as was previously anticipated. And so in April, when the markets went down, there were concerns that prices would go up so much, spending would probably slow, would end up with a recession. And so, but that went away. It's just, he puts the tariffs on, he takes the tariffs off, and the markets keep going higher, and that's the other part of this. Investors have gotten used to the threats not materializing. And in the meantime, we still have this theme of artificial intelligence and all sorts of investors coming in. I'm losing track of how many records we've set this year. So it's a great lesson, and you should ignore a lot of the noise, stay invested for the long haul, and make money, because this has been a spectacular year.
No, I think that's fair. Steve, in the midst of earnings season right now and all kinds of, I think, pretty positive things coming out. A lot of the big tech names reporting their artificial intelligence spend. We're seeing a lot of, I think, real dollars being put to work in capital expenditures. And then, of course, we get the occasional big miss from companies, local businesses, local financial services firms that, for a lot of our investors, had some small exposure, even sometimes maybe a little bit more than some small exposure. perhaps a good reminder for investors that even when you think you're 100% correct about businesses or a particular business, there's a reason why maybe we build portfolios that are a little more well thought out than just those one or two names.
Yeah, I love balance and I love diversification, but, you're speaking specifically, Kyle, to the issues with Pfizer's announcement this week. It does remind me, having moved here from Seattle, that people like to buy what they know. When I was in Seattle, everybody owned Microsoft, Amazon, Starbucks, Costco. I moved here, everybody owned, Harley Davidson, Kohl's, you name it. But the point here is that stay diversified, because you never know what's going to happen. Companies are going to miss. They're going to outperform. We like mutual funds because of the professional management that you get that diversifies the investments in the sector that you're hoping to find diversification. And we do this for a reason.
Yeah, and I think, again, there's a lot to be written still about what's going on with some of those particular businesses. And yeah, I absolutely was thinking of Pfizer. But the end of the day, it's less about what are those individual businesses doing. If you can build that balanced portfolio, that well-diversified portfolio, it's more about the broader themes overall and how can we participate as investors in the optimism that comes from just owning the economy more broadly, owning good businesses more broadly. And so, I think if we look at some of the opportunities set here in the U.S., it's clear where that is coming from. But Art, I know as we look bigger picture around the world, especially this year, it hasn't just been about the U.S.
Yeah, and you addressed this during our seminar. There's a home country bias is the term used exactly to what Steve just said. So it's either hometown or home country. Steve talked about hometown bias, but there's a home country bias. We as Americans tend to want to put money in U.S. stock markets, U.S. stocks, because we're hearing about them, we're more comfortable with them, and for good reasons. I mean, there are concerns about laws or lack thereof, accounting standards in different countries. But diversification gives you different things going up and down at different times. And so there's an article in the Wall Street Journal this week pointing out exactly what you talked about. They probably listened to your talk at the seminar, how the foreign stocks are cheaper on the basis of price earnings multiples. And specifically, and we see this every day, the foreign stuff is doing better than the U.S. stuff. So as much as the U.S. stuff is doing well this year, double it, to a certain extent for the foreign stuff. And we don't have to pick individual stocks. We have excellent managers who select individual stocks overseas for us. And this is the first time in, as this article indicated, 15 years that this stuff has outperformed the U.S. stuff. Doesn't mean it's going to continue that way, but it certainly is a reminder that diversification over time, does work.
Well, and to just add to that, Art, the idea that you're diversifying overseas, you're going to get the benefit really no matter where you're going through the currency exchange. It doesn't matter what country you're investing in per se, so much that if the dollar is weakening, you get the added benefit of repatriating those foreign currencies and foreign profits back into U.S. dollars, which adds a tailwind to your overall return. And then not to mention, in addition to the price multiples being more attractive, you got higher dividends overseas. So for income investors that are looking for some kind of income stream, foreign stocks right now are paying a much more attractive dividend yield relative to their U.S. counterparts.
And again, it's not about identifying that individual name. There's plenty of great businesses around the world. Some of them even exist in countries you might not think of as otherwise great places to invest. And so the challenge, of course, is, do I like Seattle or do I like Milwaukee when it comes to investing? Well, maybe there's good businesses in both places. And there's
good baseball teams in both places.
There absolutely are good baseball teams in both places. Art, it's hard not to talk about the Fed's decision this week. Jay Powell and the Fed cutting 1/4 point. Plenty of conversation about what's going to happen going forward. Maybe some words of caution from the Fed this week that the 1/4 point cut that so many were counting on now again in December, not a foregone conclusion. But how do you talk to investors about maybe what the Fed has to focus on? Clearly, I think the word fog thrown out there quite a bit, a lot of kind of references to the uncertainty that's come from the shutdown. What kinds of things do we need to be paying attention to right now with respect to the Fed?
Yeah, even though the markets didn't like the fact that Powell poured cold water on what he's going to do or what the Fed's going to do in December, this is typical Chairman Powell. It's typical cautious Fed chairman speak. As you said before on many occasions, as you talked about the seminar, and as you just mentioned, I mean, they're data blind right now. They aren't getting the same numbers that they used to get, so they can't. And furthermore, they don't know what those numbers are going to show in December. So it would be ridiculous for him to say, "Oh yeah, a 0.25% rate cut is baked in the cake." It's not going to happen. So. He didn't say anything that should have shocked the markets, but nonetheless, they took it as an opportunity to sell off a little bit. But then after earnings from some of these tech companies got released, thereafter, the market rallied again. So again, it's a mistake for investors to hang on every word of Chairman Powell. We know what he's going to say anyway. I'm going to assume that the employment picture is continuing to weaken for any number of reasons, and I'm going to assume that we're going to get that percent rate cut in December, regardless of what he says. He's saying the right stuff. The market's interpretation, not so much so.
Well, and you talk about fog, but that's part of the fog, is that the Fed is dependent on data, and they don't have it. So they're driving blind in the fog right now. And one of the things that, I mean, we don't know how much weaker the job market is getting. We have anecdotal things, but we don't have the numbers that the Fed usually relies on to be making these decisions.
And the economy's in a fog. I mean, we're in a government shutdown. We don't know, the long-term effects of that. Lower interest rates are beneficial, to investors and to consumers.
We were supposed to have the biggest report on the economy come out on Thursday for the gross domestic product, and included in that would have been numbers on the Fed's favorite measure of inflation, which, their dual mandate is employment and inflation, so they don't really know what's going on with either of those, because that report was blocked because nobody's at the Bureau of Economic Analysis to issue it.
Well, and of course, if we don't have data, inflation's not a problem and employment's not a problem.
There you go.
And so I feel like that's probably the easiest way for the government to simply say everything's fine, because there's nothing that tells us anything to the contrary. And that's kind of what we saw in the employment data, or in the economic data more broadly this week, was no news.
But on the other hand, people look about them and feel in a fog too. Individuals, consumers, who drive our economy. And we did have some numbers, but they were private numbers, but they were consumer confidence numbers this week from the Conference Board, and they're basically unchanged from September. But people are just concerned about inflation. They're concerned about prices. They're a little less concerned about tariffs, just because at the time of the survey there wasn't as much talk about tariffs, but they're still concerned about tariffs, and they're concerned about the government shutdown. So a lot of consumers are driving blind too.
Speaking of driving, the auto companies have done well this week. Their profits are higher than expected, or they're selling more cars despite the tariffs. And the economy and the stock market, we haven't talked about this in a while. The stock market is a leading indicator. And the fact that we're setting records on Wall Street tells us that at least the big money that's going in is driving stocks higher in anticipation of what we've also seen forecast: higher corporate profits for the year, higher corporate profits next year. So for my money, I want to have something there. I don't want to overdo it.
Well, that's the juxtaposition, right, Art? Corporate profits might be higher because they've let a lot of workers go. It's why the unemployment number keeps going up.
Steve, one of the things I've learned from you over the years is how important it is to tailor what we do to the individual. I had an interesting conversation a couple of weeks back, and I wrote about it for the newsletter that's going to come out this afternoon. But with one of our clients that had seen a video, it turned out to be a completely computer-generated video, but it resonated with him because it was essentially Warren Buffett, one of the all-time great investors, telling people, hey, if you're older, if you've got other stuff going on in your life, you shouldn't own stocks anymore. You should just own cash. You should just own CDs. And the client, with a lot going on in his life right now, reached out and said, I think there's a reason why I'm supposed to be doing this. And then, we had a long conversation about what that means. We turned around and it took some different action maybe than what I otherwise would have for the portfolio. But it was tied to the individual. And I think, certainly you've had a number of those conversations on, maybe the reason for this call is different than what we ultimately do, but how do you help clients kind of navigate some of that noise and then tailor something that's specific to them?
Yeah, that's, I think it just kind of comes with experience. We've been doing this for decades. Bob started the company in 1973, 74 when he got out of school. and he's kind of passed that all on down to us. And the one thing that I can remember the most in being in under Bob's tutelage when I first started was something he told me straight away, is that always do what's right for the client. And at the end of the day, as long as we follow that mantra, we're going to be just fine.
And it was a good thing that that client came to you, right? I mean, there might be people who are seeing these deep fakes of they look like famous or expert investors giving advice, and they might just go along with that. But at least this client reached out to you and said, hey, I'm thinking about this.
Well, and I think it speaks to the importance of having someone you can go to for those conversations. And it's part of the role we play. Sometimes I joke that I'm as much psychologist or psychiatrist maybe as I am financial advisor. I think Steve, Art, you guys probably feel the same, that a lot of what we do is really talking through the emotion that comes with investing. And again, sometimes maybe that emotion's incorrectly placed, or maybe it came from the wrong place, but the fact that you're feeling it tells me, hey, there is something here worth talking about, something here worth maybe responding to.
Yeah, Kyle, there are a lot of different types of clients out there and a lot of different types of investors, and I have found that for as much as we have a lot of people who hire us and rely on us and trust us to make all these decisions for them, I have quite a few clients who actually enjoy talking about the markets. They want us to be a sounding board for their ideas, and they make it a very engaging conversation, and they want a little bit of ownership in some of the decisions that we help them through.
Absolutely, Steve.
And then we can help them get some of those ideas. So if they're talking about artificial intelligence, we can point to growth stock managers who might have them in some of the Amazons or NVIDIAs of the world. And so they're participating in that. But over time, the most important thing to also learn from Bob is the importance of our listening to our clients, and again, helping figure out what it is that they're really trying to accomplish over short periods of time and long periods of time. Had a review with a client today. You guys see this, every day with your clients. Over decades, people make enough money to keep hopefully, to keep their money growing, to cover their expenses on a monthly or daily or weekly basis, and to travel or buy things. And it's somewhat magical to a certain extent. And in addition to being psychologists, I guess we're wizards to a certain extent, because it seems to work over long periods of time.
And also educators, Kyle, you mentioned
Absolutely.
the newsletter. I mean, the reason we do that, the reason we have this podcast is so that the clients you engage with are informed, so that you're not starting at square one when you have these conversations, that they know a little bit more to talk with you intelligently and have the questions, and they're able to articulate their questions.
And I would add, Joel, for our listeners and for our readers, that it's a way for them to share those kinds of things with the people in their life that they think it might resonate for, right? That if you know someone who could benefit from a piece of information, it's free to pass it along. And certainly to the extent we could help with those conversations, there's no cost to give them our number and say, hey, why don't you reach out to Steve? Why don't you reach out to Art? Maybe they've got something that might be helpful for you. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.